All right, we are going to go ahead and get started. My name is Brad Johnson, and I'm the general manager at Sawyer Property Management. Welcome to our Property Investment Essentials webinar series. We're going to be doing this every quarter throughout the year, and our first webinar for this year is going to be Joey Milam from Alpha Mortgage and Joey Milam Mortgage Team. So, welcome to Joey. A couple things real quick. We will be recording this and we will post it on our social media accounts within the next couple business days. So you can go back and take a look if you want, or share it with a friend if you know someone who's interested. And then we will be taking questions throughout the webinar. You will see at the bottom of your screen a Q&A box where you can submit a question. You can submit it at any time. We will wait to do our Q&A until Joey's finished with his presentation. But at that time, I will read through the questions and we'll have our Q&A session. So just remember, you can submit those at any time. All right, I will turn it over to Joey now and we'll get going.
All right, Brad, thank you so much. And thank you and Sawyer Property Management for having me. So I'm excited to talk about some of the lending options that are out there for investors and anyone wanting or interested in possibly purchasing an investment property. So I'm going to just sort of dive right in here to some of the topics I'm going to go over here tonight. First, I'm going to talk about traditional investment mortgages. These are your standard Fannie Mae, Freddie Mac, underwritten, conforming loan mortgage options. There's been a lot of changes in the market in the last few months, and so that's something we'll discuss as well. Non-traditional mortgages. These are kind of what we consider brokered loans within my company and my business. Things that not a Fannie Mae or Freddie Mac underwritten loan, commercial loans, which are a whole different sort of ball game when it comes to lending, and then just sort of give you some updates on the mortgage market and things that have changed recently that could affect you as an investor. So, getting started, a traditional investment mortgage. Traditionally, using that word, but 20% down payment is going to be the minimum with something like this. And when I say a traditional investment, as I was talking about, Fannie Mae and Freddie Mac are two of the largest mortgage buyers. They're quasi-government agencies, and they really set a lot of the guidelines and the rules and really sort of steer the ship, as it were, on how we underwrite loans, whether it be primary home, second home, investment properties, whatever the case may be. So absolute bare minimum, 20% down payment. Now, one of the things you'll hear me say through probably a couple times here is, again, the market has changed a lot in the last couple of weeks, in the last couple of months. We've just really seen some very volatile times, really starting in November. 25% down these days is typically going to get you much better terms, specifically when it comes to closing costs and interest rate. So really, and that has to do with some of the changes that Fannie and Freddie have come forth and said, they really are, their primary charters for primary home ownership. So they've added on extra pricing and costs with these loans when it comes to doing a investment property, and for anyone interested, second homes as well. But 25% in general is going to get you much better terms these days. But that being said, 20% still doable. There's never going to be any mortgage insurance really on any investment property loan. You're going to be putting at least 20% down, so it's not something that's going to be required. With that being said, I frequently have clients who may purchase homes as a primary home or a second home, probably more often than not primary, and they're going to hold on to it for a little while. They're going to move into the home, live in it for a few years, turn around, move, buy another primary, and rent that existing home out. In an instance like that, you might have, depending on your down payments, and PMI on an investment property, but that's perfectly allowable. Reserves. So reserves are something that I think a lot of people sort of overlook. I very frequently have clients calling me up who maybe don't own any current investment properties and are looking to get into that realm of property ownership. I absolutely think that certainly everyone has the right to purchase a home. But I will say in the last few months, I've had a number of potential buyers calling me up who really don't necessarily have the financial wherewithal to look at buying an investment property. Reserves are something that we look at, and this is often the case when I have a client who really just can't afford it. They might have the bare minimum down payment, but oftentimes, depending on how many properties you own, you may need money beyond what the down payment and closing costs are. And I think that's something that perhaps a lot of lenders, that if they're giving just a quick probably not a pre-approval, but pre-qualification letter, online lenders, things like that, they may not really be digging deep and looking to see what you really need to be able to buy. So reserves are essentially, again, specific to traditional mortgages, where we look and say, all right, you need to have X amount of dollars beyond what you need for down payment and closing costs in the bank, in their reserve fund. So kind of the theory is, from an underwriting perspective, that if you were to uh, lose your job, or obviously have some major financial issue happening, that you've got some money beyond what is needed to potentially float, if it will, that mortgage for a while, that you can. Typically speaking, someone who doesn't currently own any investment properties, I may not see a requirement for reserves. It really does vary depending on whether we are underwriting with Fannie Mae guidelines or Freddie Mac guidelines. Credit score can be involved in determining this. Someone who's got an 800 credit score and they're putting 25, 30% down, likely there's a good chance we may not need any reserves if it's the first property you're purchasing. Someone that has multiple properties owned and multiple properties financed, guarantee we're going to need some reserves. Sometimes it can be as much as three, typically it's going to be at least three, sometimes as much as 6 months of mortgage payments for every property owned. So it can really add up at times. Now, eventually it starts those funds can be commingled, and we can look at them from a number of different places. Great example, I've got a wonderful client here in Wilmington who owns, I want to say, about 9 properties and has mortgages on all of them. Most of them have traditional standard Fannie Freddie mortgages. Recently ran some numbers, and beyond just the standard costs that are needed, I think we had reserve requirements of around $60,000 to $70,000. So it can add up to be quite a bit. Now, the good thing is reserves can come from a number of places. Now, obviously, if you've just got money in checking, savings, great. Those are absolutely the best and easiest way to verify funds that we can use for that. Beyond that, retirement accounts. I will have clients that maybe have a 401k or an IRA. We can use those accounts oftentimes. Now, I will say sometimes there can be limitations with retirement accounts depending on a client's age. If they're of retirement age, over 59 and a half, then you can typically, without penalty, take funds out of those accounts without any tax implications, depending on 401k, IRA, things like that. If you are not at retirement age, though, we may limit somewhat how much of that money can be used for reserves. Oftentimes I'll see an underwriter say that maybe, okay, we can say if someone's got $100,000 in a 401k account, we'll say 75% of that, 75,000 can be used as proof of reserve funds. One of the things too, moving kind of beyond reserves and the funds needed, is potential rental income. This is a thing that a lot of people don't necessarily realize. And I frequently say it can many times be easier to get approved to buy an investment property than perhaps a second home. When we're doing a investment purchase, again, talking traditional, if someone, as long as you own a current primary home, and I have done loans for people that do not. I had a client one time who lived in San Francisco, pretty much the most expensive real estate in the country. I think was paying something like $4,000 or $5,000 a month in rent for an apartment. Just flat out told me, I don't want to own a home here. It's too expensive. So I rent, but was buying investment properties here on the North Carolina coast. Someone like that, we look at a little bit differently. Someone who does own a primary home, though, one of the things we do, we order an appraisal on the property they're purchasing, of course. The appraiser goes out and tells us the home is worth X amount of dollars and compares it to other properties. On investment loans, we also ask for a rental income analysis. So the appraiser is going to look around and look at other properties that are similar that have been rented and look at what they are renting for and average it out, just like they do with the value of the home. We can typically use 75% of whatever number they give us to help qualify that person's mortgage on the investment realm. So just as a kind of some quick, easy numbers, if someone was buying a home and their monthly principal, interest, taxes, insurance, PITI was going to be $1,000 per month, and the appraiser told us that the home is likely to rent for $1,000 per month, in that scenario, we would really only have to qualify them based on a $250 a month debt for the new house, because we'd be able to use 75%, $750, to offset that new mortgage. So we do that all the time. Makes it, again, much, much easier to get approved. Now, someone who does not own a primary home, we cannot do that. Not to say you can't get a loan, but we can't use that potential rental income necessarily to offset the mortgage. One question I get quite often, especially here on the coast, is, well, what about short-term rentals? For the majority, and it's somewhat appraiser discretion as to whether or not they're going to look at the property's potential rental income based on short-term or long-term rentals. Obviously, a home in a, maybe just standard HOA neighborhood, $200,000, probably going to be looking at long-term rental. A condo at the beach, probably going to be looking somewhat at long-term rental, but more than likely they're going to be looking at, all right, what are these homes actually renting for? A property like that, obviously short-term vacation rentals, month to month, make way more money, but also have typically a shorter yearly span throughout the time of the year that they're renting, maybe only during beach season, Memorial Day to Labor Day, things like that. So it is somewhat appraiser discretion, though. I rarely have a situation, though, where it comes in less than what we were necessarily hoping for it to come in at. Moving on a little bit, traditional investments, Fannie Freddie loans, they have to be closed in your personal name. So it's not something that we can put in an LLC if you have one. It's got to be done in your name. Now, I will say I have clients all the time that I know after closing, I would typically tell them, if they're going to do this, to wait a while. They're really not supposed to, but they will deed ownership of the home over into the name of an LLC. Now, I am by no means an attorney. I am not a CPA, so I can't speak to the legalities or the tax implications of doing that. I will say, from the mortgage standpoint, that is typically, certainly within the first year, going to be violating the terms of your mortgage. Now, that being said, for the most part, in reality, you're likely to never get caught at it. There's a lot of gray areas in our industry, but I've also had attorneys tell me, and again, I am not giving legal advice here, but I've had attorneys tell me that people will do this because they think that they are limiting their potential liability from lawsuits and things like that. One particular attorney told me, though, that if something were to ever really go to court, a legal case or something like that, if you truly have an LLC or a company that is set up to own investment property and set up with some funds, with bank accounts, things like that, and is really done the right way, you're probably fine. It probably is limiting your liability. However, something going before a judge or jury, and if they say it's literally, there's no bank accounts in the name, there's nothing, but you put this house in that name, they said it probably wouldn't necessarily hold up in court. A judge or jury is likely to simply say, you really did this just to try and limit your liability, which obviously we're trying to do, but you're not really operating this as a company, as a corporation. So again, not just sort of my 2 cents on the matter, and just some things that attorneys have told me. I would highly recommend anyone purchasing investment property to talk to a good CPA, to talk to a good real estate attorney, and determine how best to structure these things. Credit scores, obviously, credit and debt, debt to income ratio, assets, liabilities, these are the things that any lender looks at to determine if someone's going to be able to buy property. Generally speaking, today with credit scores on a Fannie Freddie loan, it's very, very, very rare to see anyone get approved with less than probably a 680 middle credit score when we are looking at approving someone. It's not to say that it's not possible. Someone with a great deal of assets, ton of reserves, a couple $100,000 in the bank buying a property. Maybe the credit is a little bit lower due to certain things that don't hit you as badly, maybe in medical collections or maxed out credit cards. We look at those things a little bit less stringently than, say, missed payments or bankruptcies, foreclosures, things like that, of course. So, but generally speaking, 680 is going to be the minimum. You really, in the investment realm, want to have over a 740 credit score. In the mortgage world, there's often a break in interest rate at a 640 credit score. Typically, you're not going to get approved for much of anything below that. 680 credit score and then a 740. Those are sort of the breaks where you'll see big gaps and differences in interest rate. So 740 is really what you want to be aiming for. I tell people all the time too, it's very important in today's world to know what your credit is. Credit monitoring services like Credit Karma, Credit Sesame, even the three credit bureaus, Experian, TransUnion, and Equifax, all pretty much have apps and things that will tell you what they think your credit score is. Now, when it comes to the credit bureaus, obviously, they're the ones that determine those. But for credit monitoring, like Credit Karma, things like that, I just always like to make sure people know those aren't really true credit scores. They're based on soft pull information. I'm by no means the credit guru, but I've learned a lot in doing this job. And generally, I would say anyone looking at those scores, subtract 20, maybe 30 points from what they're telling you is what I would see if I were to pull your credit score. Debt to income ratio limits. So this can vary quite a bit, again, depending on your credit in terms of how high up you can go with your DTI. So debt to income is simply us looking at a client's gross monthly income and then looking at their monthly minimum payments that show up on credit reports, any monthly debts they have. We don't look at utilities, things like that, but car payments, student loans. For in the investment realm, we're going to look at what your primary housing expense is, and we're going to look at what the potential expenses are on any other properties you own, and then certainly the home that you're looking at buying. We're going to look at the monthly principal and interest, the monthly taxes, insurance, and HOA dues to affect that as well. Typically speaking, kind of the golden area to be is 43% or lower on your total monthly debt to income ratio limit. Now, someone who has really good credit, maybe above the 740 mark, or someone maybe who has a lot of money in the bank, again, reserves can really kind of make or break deals many times. Someone that's in those higher realms may very well be able to go up to 47, 48, 49%. 50% is too high. 49.9%, maybe. When you start getting those higher numbers, very, very difficult to get approved, but not at all impossible for someone that's really well qualified. Conforming loan limit. So when I'm talking about Fannie and Freddie Mac loans like this, there is a loan limit as to how high you can go and keep it as a conforming loan. That amount in most of the southeastern North Carolina region would be $647,200. So a loan of 647 and 201 would be outside of the realm of conforming, and it would be what we call a jumbo loan. Now, there are a few areas for any of you that are out in more urban areas. Charlotte, I believe, is the only one in North Carolina. Certainly the DC area, Atlanta, any of the bigger cities, they do have a higher conforming loan limit, sometimes up into the $800,000-900,000 range, I believe. I will also additionally say anyone that looks at multifamily properties, so duplexes, triplexes, quadplexes, when you're buying those properties, the conforming loan limit goes up as well. I believe it's into the 700s for just a duplex. So that's something a lot of lenders who don't regularly deal with investment properties and certainly don't regularly deal with multifamily properties don't always realize that. I've had a client come to me before who said their prior lender turned them down because it was over that limit and they couldn't do it. And I said, well, you're buying a duplex. Yeah, you're fine. We can do that. So, and those are obviously phenomenal investment opportunities when you can find a duplex or a triplex in our area. Moving on kind of from into the traditional loans, we can talk for a little bit about non-traditional mortgages. This is a mortgage that is not insured by Fannie or Freddie. It's really private investors that are out there. Our company does do these loans. And they are just a lot more stringent underwriting criteria in some cases. So the most popular one for the investment realm would be, it's just something called an investment non-trad loan. We actually have a product now that if, maybe you're self-employed as a purchaser, or someone who doesn't necessarily qualify based on your traditional income of salary or hourly or whatever the case may be. With this product, as I said, we do the appraisal and we try and get it as quickly as possible with one of these loans because we're going to ask for that rental income analysis. And as long as in this instance that the rental income analysis, let's just say it's again $1,000, and your principal and interest, taxes, and insurance is going to be $1,000. We're not doing 75% on these. As long as the potential rent exceeds what the monthly expenses on the house are, as long as that is the case, you are likely approved for the loan. Now, there are, of course, a few things. You've got to have at least a certain credit score, bare minimum of a 620 with this type of loan. You've got to have certain amounts of reserves, typically 3 months worth. And the lower, I will say, with all of these loans, the lower your credit score, a 620 is probably a 40% down payment. Someone with a 740 plus, little as a 20% down payment. But in that instance, as long as the rental is more, you're approved for most instances. We've also got bank statement loans. Now, this is something that we would use for often I use this for a self-employed borrower, whether you're buying, and this would work for an investment property, second home, primary home, whatever the case may be. But in this one, we do it a little bit differently. We would look at 12 months of your bank statements, maybe as many as 24 months. So we look at that and we say, all right, what is your real monthly income? Oftentimes, self-employed borrowers, I see it day in and day out, they write off most of their income. With a traditional mortgage, we have to go by what you file on your taxes. There are a few calculations we do. Certain things can be added back in, but for a client that's written off almost all of their income, or maybe just didn't claim a lot of their income, maybe it's a cash business, things like that, we can look at bank statements and see, all right, what is this person really truly making? What is their real income, taxes aside? We basically look at whatever bank statements are going to have that income. We average it out per month and then average it out over the year time period. And that's the income that we can use. Ultimately, these loans do have higher costs and definitely higher interest rates. It really depends a lot on credit as far as what the rate, it depends on which of these different programs we're looking at, bank statement loans, investment loans, things like that. And the closing costs are typically going to be much higher. On average, I would say around 2% origination points added on to a loan like this. So meaning if you're doing a $100,000 loan in theory, it would be an added $2,000, 2% in closing costs. So it can add up though for higher dollar amounts. $150,000 loan is actually the minimum with these. We can go up to $1.5 million with these though. Don't necessarily like talking about the rates because again, they vary widely, and these rates for these types of loans are very volatile oftentimes. I would say right now, probably nothing lower than 5%, probably up into the upper fives, maybe even sixes, but they can be an awesome loan product for someone who doesn't necessarily have any other options or just doesn't have the income, but wants to get into investment property owning. They also take a lot longer to do. A traditional mortgage, we can usually close in 25, 30 days. Mortgage like this, bare minimum, 45 days, typically really more like 60 days to get one through to closing. As I said, 3 months reserves minimum, you've got to have. With these loans, you can absolutely close them in an LLC. It's still going to be based likely on your personal credit score, but we can put them in the name of an LLC at closing. Again, minimum 620 credit score, not going any lower whatsoever on these. These loans are usable for a single family home, any type of duplex, things like that, and condos as well. So we can do those. Generally, they are not going to be available for condo tails. And just to kind of speak on those really quickly, condo tails, for those of you that may be looking at beach properties, North Topsail in particular has a lot of condo tails. Shell Island at Wrightsville Beach is considered a condo tail. It's essentially they're individually owned condos. They're deeded as such in a building, but the building, the condominium complex, has on-site rental management. The HOA actually manages the condos for you as if it were a hotel. You might be able to rent them out by the night, by the week, things like that. Buildings just as a general rule, if the name of the building has the word resort in it, it is often a condotel. If there are amenities like an on-site restaurant or things like that, it is often a condotel. There's a couple, I believe, one or two in Carolina Beach, one or two on Wrightsville Beach, a handful of them up on North Topsail, sort of in our local areas. Condotels are traditionally very difficult to finance. Now, I will say we have a few options with non-traditional. It's on a case-by-case basis on whether or not they will be financeable. Really, we have to send it off to the underwriting company that does these, or one of the few loans that we don't underwrite and take care of in-house. But we send it off to them. We have to send off a condo questionnaire, their budget, all that information, and they'll let us know if it's something that's doable. Moving on, talk real briefly about commercial loans. So a commercial loan is basically a bank. It is not, I will fully admit, not a loan that my company offers, but it's simply a loan. You're going to a bank and saying, I want to buy a property. You're using the property as collateral, but you're generally personally guaranteeing it. You can close in the name of an LLC. And oftentimes they're a 20-year term. Different banks are going to have different options out there. I highly recommend for anyone looking for a loan like this. There's a gentleman by the name of Paul McCumbee here in town. He does a lot of these loan types. He's a local bank called Southern Bank. And I actually reached out to him recently, just a few days ago, and said, hey, Paul, give me kind of some bullet points that I can tell everyone that I'm going to be speaking with. And so he was telling me they're typically a 20-year term with them. Oftentimes it's sort of a set rate. I hesitate to call it an ARM, because it is usually a set from he said, typically starting with a 5, maybe as far up as a 10-year initial set rate, and then it may adjust afterwards. But typically it's only going to adjust one time, but based on various financial factors at that point. It's always going to be 20% down. I do know one of the things that I get asked a lot is, can we do maybe some renovations? Can we include some updating on the house when we buy it into the loan? With most traditional loans, the answer is no. There are some renovation loan programs out there, but they are, quite frankly, few and far between these days. The non-traditional loans, I don't really have any options for those, but again, that's any type of renovation loan is really going to be non-traditional. Commercial loans, they do offer this, particularly if it's a client that he was telling me that they have a good relationship with. If it's someone that banks with them and or maybe does multiple loans like this, oftentimes they will say, all right, maybe we'll do a 100% loan with, you're still going to put a 20% down payments and you're going to put cash into the deal, but maybe we're lending up to the appraised value so that we can do some renovations and things like that into the loan, but they know that the property is going to end up being worth considerably more. Probably not for someone who's just looking to put in some granite countertops and floors, but for a home that really needs some renovations. Again, it's always going to be on a case-by-case basis as to how that kind of hands out. Again, really great guy. My family's worked with him for many years, and anyone that's looking for something like that, he's the guy to go to. I will say commercial loans, generally speaking, you're probably talking about higher interest rates, probably a little bit longer maybe to close, somewhere between the 30 and 45-day mark would be my guess. Interestingly enough, oftentimes they will have some somewhat reduced documentation though. Oftentimes I myself have done loans like this, and it may be that you're filling out a personal financial statement, maybe providing a few pay stubs or W-2s, bank statements, things like that. And they're not necessarily hard loans to get approved for, but they are a shorter amortization term, just less favorable terms in general. So, all right. So last but not least, by any stretch of the imagination, I kind of wanted to give some mortgage market updates. So there's been a lot of changes in our industry, certainly in the last few years. I mean, our industry is always changing, but in the last, I would say, starting in about March of last year, and then again in November of this year, and then just in the last few weeks, we've had some major changes that would affect anyone looking to potentially buy. So back in around March of last year, I believe it was, again, I believe touched on this a little bit earlier, but Fannie Mae and Freddie Mac essentially came out. There is a regulator that was head of one of the large regulatory, there's any number of uh, regulatory agencies in our country regarding mortgages. But one of the chief regulators essentially came out and said, we really don't want Fannie Mae and Freddie Mac and any government agency focusing on second homes and investment properties. We want them focusing on primary home ownership in the United States. They essentially said that we want those organizations to have less than 7% of their portfolio of mortgages made up of those types of loans, of the secondary and investment property loans. Needless to say, in some areas, not a big deal at all. If you're in a highly rural area or area where there just are none of those loans, not a big deal. That was a big deal to our area here along the coast. We have a huge rental and investor concentration in our areas, so really affected us. One of the ways, anytime any bank, organization, agencies like this, you want to stem the tide of incoming loans or a particular type of incoming loan, raise the interest rates, add costs onto them. So they basically said on both of those realms, we're going to add in 2 points of cost on these. And when I'm talking about points in this regard, I'm talking about the pricing on the back end of the loan that really only lenders see. Meaning it's more expensive for us to do the loan. And in all fairness, we're making less money on those loans. And across the board, all lenders, of course, are going to say it is a business. All right, well, interest rates are going to have to go up to accommodate this, to make up the difference. So starting in last year in about November, we saw investment and second home rates go way up for a while. And I will say way up for what the rates were at that time. We had been enjoying a year or two of indescribably low rates, as everyone knows, and really one of the best years ever in our business was 2020. When that happened, those shot up. Investment property rates have essentially stayed up. Second home rates did go down a little bit to some degree over the last few months, but starting back in November, we started seeing interest rates across the board, primary home, second home, investment properties, everything. We started seeing rates start to climb. In the last month or two, starting this year, we started to see them really climb, start edging up into the fours. And then in the last few weeks, we've seen some major shifts with regard to investment properties and truly second homes as well. Those two, again, I keep saying them both, but they're sort of lumped in together. In general, and this is where I was talking earlier about 20% down. Again, I don't like quoting rates in a time like this, in an event like this, because it does vary a great deal based on an individual person. But you're going to see rates probably putting 20% down in the fives, with possibly charging a couple points, origination points, so added 2% in closing costs to do a loan. 25%, we might see it start getting back into the fours, or it may still be in the fives with no points. We've seen those things climb quite a bit. Again, Fannie and Freddie have fallen in step and simply said, primary home ownership is what we're focusing on. And traditionally, they've always been the best interest rates when we are, sending loans out there into the world. And when they're doing that, now we're relying more and more on private investors who are purchasing up loans, but theirs are as well like that. I know our company has been working a great deal in the last few months, really in the last year, searching out as many private lender investors, and it's the mortgage secondary market, as we call it, where we sell our loans to. We've been trying to find as many as we can to partner with, to offer the lowest rates that we can since this has happened. Again, as I said before, higher down payments equal better terms across the board, and that's really true of most any loan type. Additionally, too, they've added on, really just underwriting changed quite a bit too last year, and really over the last few years with regards to, we're looking at investment property loans just a little bit stricter. The amount of reserves have gone up. I will say in times gone past, in years gone past, I could look at a loan that was, good credit or decent credit, shall we say, low 700s and good things. I'd say, oh yeah, it's no problem. It's easily going to be approvable. It's not always the case now. And I would kind of tie this in with, anyone that's looking to purchase homes, please, 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 please always go get pre-approved with whoever your lender is early on in the process, really before you start looking. I can't stress that enough. and really make sure that they're doing a good, thorough pre-approval. When I have a client who owns multiple investment properties and maybe they're self-employed and things like that, it is not an hour-long process. It might be a day process from the time that I get all of their documentation. I have clients that own 6, 7, 8 investment properties. There's a lot of calculations you have to go in and do on each one of those properties to determine how much rental income are they really getting from it. And I would kind of bring this up as well while I'm talking about this. Uh, Inevitably, all the time, I have investors, property owners calling me up. Well, I'm making $5,000 a month. That's maybe a bit high. Let's say $1,000 a month on that home, and my mortgage is only $500 a month. So I'm making $500 a month profit with that. Okay, that's great. That's how much cash flow you have. That's not necessarily how we're going to look at it from a lender standpoint. Someone who has a property and they've had it for at least into the prior year's tax return. So any property bought last year is going to show up on a person's 21 tax returns when they file them. I'm going to look at those tax returns, and it's likely going to have what is called a Schedule E, profit and loss from a property. I'm going to look and see, all right, how much rent did they show? And what were their expenses for the property? What were the taxes, insurance, mortgage interest paid, HOA dues, all of those things. And there's a calculation that we do to determine how much the actual income was. So it's not necessarily your cash flow income. Excuse me, I've been talking too long. So we really have to go in there and do that. And it can take some time when we have to go and calculate out income on multiple properties. So try and get pre-approved as soon as possible if you're looking to buy investment. And really that's true of any property. And just make sure, again, your lender's actually doing those crunching those numbers. Someone that makes $1 million a year and has a ton of money and doesn't own but a primary home and one of the property, sometimes we can look at it and say, yeah, of course, this person's easily approved. That is I would tend to say, more rare occurrence. More often than not, there's a lot of nuances, and looking at someone's credit and have they actually run it as a lender actually run it through an underwriting system or had an underwriter look at it. Is it a really good, strong pre-approval? I am incredibly aware of the money that people are risking when they're putting an offer in on a house. In North Carolina these days, you're pretty much offering a lot of due diligence money up front, which if you do not close on the home, if your offer is accepted and you don't close on the home, that you're out that money. I'm very aware of that. I want to be really, really sure that my clients are good to go, that they're going to be able to purchase that home and not lose their money. I don't want anyone angry at me over that. Last but not least, I want to talk about condos for a minute. So in the last few weeks, there has been a massive shakeup in the way that Fannie Mae and Freddie Mac underwrite and have us look at condos. So anyone that's looking at beach investment properties or any type of condo, it's going to take longer now, most likely. But because of the very, very sad, tragic collapse of a condo that happened last year in Florida, they have really been mulling this over for a while, Fannie and Freddie, and saying, all right, we need to be sure that when we're lending on a condo, that it's structurally sound, that nothing like this is going to happen. And I will say, this is not just coastal, this is everywhere. The homes can be in Kansas, the condo, and we're still going to have to look at these things. The Condo Questionnaire. So when we're doing a loan for someone purchasing a property that is a condo, we oftentimes have to get what is called the Condo Questionnaire filled out. It's a long document. It was traditionally about 4 or 5 pages. Now it's at 7 or 8 pages. We would have to send it off to usually the HOA management company and get them to fill it out. And it would say things like, is the HOA currently involved in any litigation? Are there a certain amount of investors that own property or own a number of the units? For instance, if one entity owns 30% or 20% of all the units in a building, that can cause a lot of issues. That's usually not going to be financeable if we know that, because they have undue influence over the HOA. There's any number of other things it asks as well. We also have to get copies of the master insurance policy on the building, copies of the budget. It can be fairly intense. Now, with a 25% down payment, we oftentimes don't have to get as much of that. We traditionally would not have to get the condo questionnaire filled out because they were putting enough money down, we didn't necessarily need it. Now, certain issues like litigation or the number of investor concentrated ownership in a building might still show up on an appraisal, which would then cause an issue. But sometimes we were able to kind of get away with certain things because we were putting enough money down. Now, the rule is, even if someone putting 25% down, we don't necessarily have to get the full questionnaire filled out. We do have to get the additional questionnaire now that is to do with structural integrity of the building. I won't go through the entire amount of what all is covered there, but it's asking a lot of questions about, does the HOA know of any existing deferred maintenance? Things like the roof has issues and is going to need to be replaced. If so, is there a plan in place to do that? Is there a schedule for when it's going to be done? Is there money set aside in the reserves to cover that? If not, will there be an assessment? Has that assessment been approved? It really delves into that. Have there been any prior damage? Has that been remediated? I will be very honest, and this is something our industry is really still learning and digesting all of these new guidelines that have gone out. And please know that Fannie, Freddie's huge government agencies are not always 100% clear when they write their guidelines. There's a lot of gray area oftentimes. We're very fortunate in that we have several contacts at our company directly at Fannie Mae and Freddie Mac that oftentimes can give us opinions if we have a question on things, and we can usually get those answered fairly quickly. But it adds a lot on there. So we're really looking at those items and kind of looking over them with a fine-tooth comb. Probably the most problematic thing that I'm seeing is that we now, anytime we're doing a condo, we have to get 6 months of the HOA Board of Directors meeting minutes. So hopefully they are having meetings. I've not yet necessarily come across one where they just simply don't have meetings, but I would bet very good money there are HOAs out there. There are condo buildings out there that are not having regular meetings. I do know of one. They only hold an annual meeting and that's it. The Board of Directors just does not feel the need to meet that often. In that particular instance, we were able to use the annual meeting minutes and make it work. But what we're really doing, and really what the underwriters are doing, searching through those meeting minutes to see again, are the Board of Directors sitting there saying, oh, we know there's this structural issue on building number 3, but we'll deal with it down the road. That is not what we want to hear. That is going to potentially cause a big problem. If there's, hey, we know that there's an issue. What are we going to do about it? Let's start getting a plan. We're going to ask, all right, is there now a plan in place? Just like I was saying. Additionally, we asked too, as part of the questionnaire, have there been any recent, in the last few years, structural engineering inspections, things like that? If so, did they find any? I'm doing a condo right now that thankfully I was able to get on this very early and get all the documentation I needed. But there was a recent structural inspection 2 years ago after Hurricane Florence, I believe it was, and they did find 1 or 2 issues. We were able to show through the HOA documentation that these items were remediated and dealt with, and there's no issues. So the underwriter said, this is awesome. This was a perfect one. Let's rock on with it. So long story short, the big takeaway, condos are going to be a little more problematic now. Highly, highly, highly recommend. And this is where truly using a local lender, obviously I'm local, so I'm a little biased on that, but using a local lender is really going to help. We have relationships with a lot of the HOA management companies out there, and we know who to call and get access to that information as quickly as possible. For anyone that owns a condo and is looking to list and sell that condo, maybe you reach out to a lender and say, hey, can we go ahead and start collecting this information? What are you going to need? Let's make sure that it's good to go before we list it. And if not, all right, here's what I'm going to have to deal with. So that's just sort of some general ideas of market, what's going on in the mortgage industry, all things that kind of relate to investment purchasing and real estate investing. Brad, I think I'm down sort of to the end of sort of my presentation here. I wanted to leave a little bit of time at the end for any questions that anyone has. Happy to answer them. And yeah.
Cool. Sure thing. I have a bunch. So
okay.
we will
I'll try my best to answer them.
Okay. Yeah, we'll get through as many as we can. All right. First up, kind of starting with the basics. How do you get started? When's the best time to contact a mortgage broker about investment property? And is it once you found a property, or is this something that you should try to do beforehand, get
No, 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 no,
pre-approved,
no,
all
no, no.
that?
Yeah, good quick example. Had a client today, wasn't an investment purchase, but called me up, desperately wanted to put an offer in on this house. Self-employed, has 3 different companies. Like I said, it takes time sometimes. I was on it. We got on as quickly as possible, but it had gone under contract within like 3 hours of him calling me. Absolutely. How to get started would be to contact, hopefully me, but any good local mortgage lenders. What I always recommend. My phone number, email address, website address, everything's on there. It's usually just a matter of filling out a quick application. The vast majority of my clients fill out an application online. It takes like 10 minutes or so on my website. And that gives me the information I need to be able to pull credit, take a look at assets, debts, things like that. Often we may collect a few quick documents. Pay stubs and bank statements are the 2 most common things for someone that's a salaried employee. Someone that's self-employed, again, going to be a little bit more documentation, probably some couple of years of tax returns, business and personal tax returns, things like that. But I would really recommend doing it as soon as possible if this is something you're thinking of doing. Now, you're thinking next year, I'm going to buy something. Yeah, no, there's probably not any need to do it now, unless you think that you may have credit issues. If you know that your credit's up in the 800s or high 700s, you're probably fine. If you're not entirely sure that you're above 740, I would suggest contacting a lender as soon as possible. Here's the thing, I can pull your credit now. I have a credit analyst that works at my company free of charge. All she does is look at people's credit all day long. She has simulation software where she can say, all right, if we pay this down, do this, do that, we'll get your scores up as high as possible so that when you do buy, you're getting the best terms possible.
That's great. That's good to know. You mentioned potential rental income as a way to qualify pretty much in all types of loans, particularly the first two. How is that potential rental income calculated?
So an appraiser does that when we order the appraisal on the home, who tells us how much the home is worth. They are also going to look through, rental statistics or numbers of rentals. There's not a lot of that on the MLS. So typically they're going to have to do a little bit deeper dive. They're going to look around at other properties that are renting that are similar properties, just like when they're valuing the house, and say, okay, maybe this home is 3 bedrooms, 2 baths with a 2-car garage and renting for $1,000 a month. This home is 2 bedrooms, 2 baths with a 1-car garage and is renting for $800 a month. Well, the home that we're looking at is 3 bedrooms, 2 bath with 1-car garage. So maybe the rent's somewhere in the middle. Maybe it's $900 a month. I'm not an appraiser, but the appraiser is the one who determines that and calculates it. Again, beach property is going to be a little bit different. They might actually start looking at short-term rentals, things like that, hopefully. And we can ask them to do that as well. They're under no obligation to do it, but I'm generally going to ask that if I know I have a client that's buying a property that's likely to be a short-term rental.
Okay, what if the property is occupied? Are you able to use the lease or a current rent roll or a rental history or anything like that?
To some degree. So if it's actually currently rented, more often than not, that amount that it's renting for is what the appraiser is going to use as the rental analysis. That is what the amount's going to show. Now, if it is I've had situations where maybe someone was renting to a long-term tenant and had just never raised their rent. It might a little bit, they're charging $1,000 a month when they could be charging $2,000. It may be higher than that. I don't usually see it in the opposite direction. So usually, yes, they're going to use whatever it's renting for currently. We can't just use, in some instances, we can actually use what it's renting for if it's someone who's already a investor with other investment properties, but more often than not, we're just going to go by the appraisal amount.
Okay, thanks. Can you talk a little bit about, one way that a lot of people get into investment real estate is to move out of their current home, maintain that home, and move into a new home. Can you talk a little bit about the process of getting equity out of your current home in order to buy, in order to keep that home or to use it to buy additional properties and things like that?
Yeah, absolutely. So That is very common. And one thing I will say, so someone who, I'll talk about equity in just a second, but if you are moving out of your existing primary home and purchasing a new home, you can, in many instances, now again, here we're talking about someone getting truly a new primary home loan because they're going to rent out their existing primary. In most cases like that, it varies depending on the loan program because you might be doing an FHA loan or a VA loan or whatever the case may be to buy your next home. We're normally able to use 75% of how much you're going to rent your old home out to offset the old home's mortgage. So, and this is where maybe kind of a quick example, you're buying a new home, you're going to close on the new home March 1st, and you've already gotten a tenant in place. Now, maybe they haven't moved in and taken possession yet. Obviously, you're still living in the home, but you have a lease in place for someone to move in and take possession of that home as a tenant on March 15th. We would get a copy of that signed lease, a copy of the first month's rent check and first month's security check prior to closing on your new home. We could use 75% of whatever you're leasing that home for to offset the old mortgage. Now, we cannot use any excess of that as income. It only offsets the old mortgage. So if your mortgage is $500 a month and you're going to rent the house out for $1,000 a month, 75% of that is $750. We're only going to give you $500 to offset the old mortgage. You can't count that extra $250 as added income to qualify for the new house. But it is possible to offset the old mortgage. As far as equity is concerned, yes, I have clients all the time that maybe they have a home equity line of credit on their existing home. You can use that to for the down payment on an investment property. Now, we are going to look and see, obviously, how is that going to change the monthly payment on that equity line, but it is doable. My company, we do not actually do home equity lines. That's really more of a bank product. And the guy I said earlier, Paul McCumbee, I don't know that he personally does them, but I send clients to them all the time to set up equity lines for things like this. Generally speaking, with most banks, they will allow you to go up to 80% of the value of your home in total debt with an equity line. Some banks, I think, will go up to maybe 85%. So what that means is if your home's worth $200,000 and you owe $100,000, you could, if we could go up to 80%, that's $160,000. You might be able to get an equity line for $60,000 in that instance. And then that's absolutely usable. I will comment real quick. That is one of the few times you can use any type of loaned money to purchase a home. You cannot use unsecured debt. I frequently have had people ask me if they could put the down payment on their home on their credit card. You cannot do that. It has to be secured debt, collateralized debt. It can't be just like a personal loan or anything like that. Additionally, on investment properties, your down payment and cash to close reserves cannot be a gift from anyone. I've had instances where mom, dad was going to give their kids some money so they could buy an investment property. You cannot do that on investment loans.
Yeah, that's good to know. Next question here is, can you explain origination points a bit more and how those origination costs are calculated?
Yeah, absolutely. So in the mortgage world, there are two different types of points, origination and discount points. And they're really, from a calculating standpoint, they're the exact same thing. They have different purposes, but 1 point equals 1% of the loan, and we're charging that on the loan amount. So if you are getting a loan and you're paying a point and you're getting a loan of $100,000, you'd be paying an added $1,000 in closing costs to do that loan. Now, origination points are very rare, actually. We really don't, we never charge them really at our company. Discount points are by far the more common thing that you see. Now, like I said, someone putting the minimum down payments may have to pay a few points, discount points, to even be able to get the interest rate or do the loan these days with investment properties. Again, minimum 20% down payment. Now, 2 points is 2%, half a point's 0.5%. There's no set rate or anything like that. It's just when we go in and put the loan file into our pricing engine, it's going to tell us, here's the best interest rate we can give. And again, these days we are seeing sometimes with the minimum down payments, and here's how many points you have to charge to do that loan. Origination points are really, we just don't see them very often. It's not something that I don't think I've ever done a loan with an origination point outside of some down payment assistance, first-time buyer programs. but it's just a percentage based on the purchase price of the home.
Okay, thanks.
I would say real quick, a lot of times you'll see this online banks, big banks, be it Bank of America, Wells, Rocket, things like that. Anyone that advertises their interest rates on mortgages, and you're never really going to say investment property rates advertised, but anytime you see rates advertised, better bet those are the best possible scenario rates. That is an 800 credit score, 25% down payment, low debt to income, low loan to value, all those things. So they're often going to show a really low interest rate. And it may be that they're showing, if you look down in the fine print somewhere, legally we're required. I will tell you, there's a company here in town that does not show the fine print. I don't know how they haven't got caught yet, but you have to show what those points are. So, I see it all the time, just as an example, not to pick on them, but Quicken, for instance, and Rocket, their rates are not actually good. They're usually pretty high. They advertise really low rates because they're charging points on it. And a lot of times it's kind of a bait and switch tactic. Our company has just always taken the stand. We're not going to advertise rates anywhere because it's so varied depending on credit and scenarios. And we don't want to bait and switch people. So.
Okay, sounds good. Couple more with the caveat that you are not a CPA and are not giving out tax advice.
Yes.
Could you explain opportunity zones?
I would say, my personal opinion, and I think what you mean is, who is best poised to be investing in real estate and what are maybe some of the best areas to do that in. I'll be very honest. I've had clients who come to me and I really tell them real estate investment's really not in the cards for you right now. And it's not really in your best financial interest. I definitely think someone who's got the money saved, I would, and this is me personally, if I were buying investment property, which I plan to start, I've had some in the past, I plan to start up again, probably next year, buying up some. I want to have easily the 20-25% down payment, certainly in easily accessible liquid funds. Now, maybe I've got investments and things beyond that. I'm going to want to have some money in the bank beyond that for the reserves. I think you really want to, and this is where I think someone like Brad, Sweyer Property Management can probably give even some advice and guidance on this type of thing. What are your expected costs on a property? On a condo or, a townhome, probably pretty little. Your exterior maintenance, things like that are mostly included. Probably only got maybe some turnover cost, replacing the carpet occasionally, paint, cleaning, maybe a new HVAC unit every once in a while. But it's really important to think about those things and to plan ahead. I oftentimes tell clients, what I would do as a first-time investor when I have them that are new, set up a separate bank account, let the mortgage be paid out of that and let your rent go in that and don't touch it. Let it build up yourself a nice, nest egg of money for that particular property, and then do the same as you add more properties to it. This is my 2 cents here. I see right now properties that are not in the city limits. If we're talking New Hanover County or really anywhere where you've got higher taxes, I've always said, brick ranches with a new roof and laminate flooring inside, you can't really do much damage to a property like that. So I think, things like that, just think long term. I think I was telling, Brad and the others earlier, a lot of people right now are asking, is now a good time to invest? Rates are up a bit, prices are up a bit. For the long-term investor, the person that's wanting to buy and hold and have that long-term passive income, absolutely. I don't really think the timing matters. Obviously, we all want low rates. We want the lowest price possible. But for long-term ownership, it really doesn't matter necessarily as much. Someone looking to flip a home, now is probably not the time necessarily. But that's a totally different type of investing. I hope that's what you meant by the opportunities.
Yeah. And then the last question is kind of a question for both of us, and I'd like to hear your personal answer. I'll kind of give my spiel a little bit first, but someone asked, what is the best way to find properties? So there's a few different things that we can do to help with that. Obviously, we are a property management company, so that's our primary role in the matter. But we can help set you up with an agent who is good at finding these properties. Another thing that we do, a service we provide for free for anybody, is what we call our investor list. So whenever someone comes to us and says that they're going to be selling their property or they're interested in selling their property, we will send an email blast out. Oftentimes, these are off-market transactions. These aren't listed on the MLS yet, so it's a good opportunity to be able to get on something early. So we do some of that, and then Charlotte just jumped on, and I will let her speak to that a little bit more as well.
Yeah, I think it right now with the competitive market and everything, you really do need an agent to help find a property. And most certainly we can even help connect you with an agent for specific areas. And somebody just asked, how do you get on the investor list? If you'll just email us, we'll be glad to put you on that list and kind of get an idea of what you're looking for.
Yeah, I could not agree more in terms of having an agent, having someone that knows that local market where you're looking, and they may have resources like this. Agents are not just sitting around looking at what's on the MLS. They're going online. They're looking at for sale by owners. They are, digging deep to find listings right now. So it's, having a good agent that can not only that, but can negotiate, that can really help you and represent you. I will tell you, from a lender standpoint, as lenders, we kind of cringe inwardly when I get a client calling me wanting to do, a loan, and it's a for sale by owner situation and no agents are involved. I just know that it's going to be a lot more work, and it's usually going to be a more difficult transaction. Agents make it easy. So yeah, utilize them all day long, please.
Yeah. The other thing I would say too is that we are happy to help you try to understand what a potential investment home will rent for. So there's a lot of confusion about how to determine rents. That's kind of why I asked, what does the appraiser do? Well, we have a ton of data all over the city, all over Leland, all over Pender County. Because we manage so many homes, we can try to help you get a pretty accurate understanding of how that home is going to rent, so that you can start to do some of those calculations with your mortgage banker to figure out, is this a good investment for me or not? And Charlotte is a great contact person for that. She does this all day, every day, and she knows those rates.
I would imagine you all probably get, I don't know, maybe not, but I would imagine you probably get calls from appraisers from time to time asking what are homes renting for, this type of home. What do you think we can get for it? So yeah, I mean, that's a service you are providing to them, and in turn to investors, realtors, lenders, everywhere, everyone.
Yeah. I got one more question, and then we will head out. It says, Joey, when the appraiser is basing loan of the income of rent, are they long-term? I'm sorry, are they long-term rates that they only look at, or do you ever look at STR income?
Generally speaking, it's going to depend somewhat on the property, and there is some appraiser discretion here. Most of the time, if it's a home in, kind of a cookie cutter neighborhood where it's likely going to be a long-term rental, they're going to look at long-term rentals. For short-term, beach properties, condos at the beach, things like that, downtown properties, maybe urban areas. Yeah, if they can find the data and use it, and we absolutely can tell the appraiser. Again, it's up to them. There's a myriad of regulations and regulatory stuff between, air gap between the lending staff and the appraiser. But we do ask them, hey, this is likely going to be a short-term rental. Can you take that into account when you're doing your analysis? So, and that is where, we're going to try and tell them, hey, reach out. We can't rely on them to just look at the MLS. There's not a lot of rental data in MLS. We're going to tell them, hey, maybe reach out to some management companies, ask them, what are these similar properties renting for? So it's not a guaranteed thing, but in most instances where I've done this, they're willing to look at the short-term rental stuff. And honestly, too, even I've had them where they haven't done it and looked at a long-term rental at the beach or property like that. Oftentimes, even the long-term rental is going to be a lot more than what it would be elsewhere. So I don't think I've ever had a situation, knock on wood, that the rental analysis came back low and caused a problem with the loan or anything like that. And I will say, I'm fairly conservative. I am very much out of the box, try and be creative and make any loan work I can possibly make work. That being said, I know people's money is on the line. I try and be somewhat conservative. So when I'm calculating those numbers, if I think the home's probably going to rent for $1,500, I might put $1,250 or something in there when I'm initially estimating it to approve someone.
Yeah. Okay, great. I think that is going to do it for us. So, oh, I got one more thing. Please share the email to send the request to be added to the investor list. Charlotte, if you will give your email out real fast, or I see you're typing it, but if you'll say it as well, that'd be great.
Sure. It's CYOW@SweyerRentals.com.
CYOW@SweyerRentals.com.
Yes.
Okay.
I need to be on that list, actually.
It
sounds like a valuable list to be on. All right. Well, thank you all so much for having me. I've enjoyed it.
Yeah, absolutely. Go ahead and take down Joey's information right there. And thank you everyone for attending. Thank you so much, Joey, for agreeing to do this. I think this was great. We had great attendance and great questions, and we really appreciate it.
Absolutely. Thank you all for having me.